I've recently encountered a number of conversations with property owners that have a mortgage payment that's higher now than what the rent is actually going to be on their property, and it's creating a big problem. This is Ron Wysakarski with Blue Palm Property Management. I want to talk to you today about how we are helping our owners overcome this tough situation. Now, let's face it, some people became an accidental landlord. They moved and they didn't intend to be renting their property out. But with the recent market, we're noticing that if you bought in the last couple of years, it may be difficult to sell your home, pay all the closing costs and fees, and have any money left over. And in some cases, maybe you have to write a check to actually sell your house, which is unattractive to most people. So the other side of it becomes rented out, and that's where accidental landlord comes in. And maybe things were moving along smoothly, and you did that, and you were able to make just enough money to cover the mortgage. But after the first of the year, all mortgage companies do what they call an escrow analysis. And what that means is they're going to examine the taxes that were paid on the property in the prior year, as well as the insurance. So when you move out in many areas, you go from an owner-occupied property, which has certain tax advantages available, and then the insurance may go up or down depending on any liability, any claims, or if you've moved out, it could cost more or less. So what happens is this: come the first of the year, you're barely making it on the mortgage payment, and now the escrow has to be increased because the taxes might have gone up due to that situation, and or the insurance, they both went up. Some people are getting payment shock. And it comes in two forms. Number one, let's say that your escrow was $200 a month short. Well, that's all well and good, because what you can do is just pay the difference. So if you're $2,400 short, write them a check for $2,400, except for a lot of people don't want to do that. But then you also have to budget for the next year. $200 short for the next year too. So if you're $200 a month short, like $2,400 short, it's not going to increase your payment $200 a month. It's going to go up $400 a month. And this is where the problem is coming in. Through no fault of their own or no realization of their own, these accidental landlords are seeing higher mortgage payments thinking that something changed. Well, it's not your interest rate, because that's in most cases locked in. So that can't change. So the principal and interest portion has not changed. But the taxes and insurance, if they've both gone up, then it follows suit that the payment's going to go up. And the banks have to recapture in this escrow whatever was short from the prior year, plus have enough set aside for the next year. So when a owner encounters this, it's unlikely, and let's just say the rent was $2,000 a month, it's unlikely you're going to increase the rent $400 and expect a good result. What will happen is your current tenant's going to say bye-bye and leave. And now if you advertise it at $2,400 a month, you're probably going to get crickets for a response. And the reason is because it's above where most people are willing to pay. And with other people in the same situation as owners and landlords, they're competing to avoid the vacancy. And here's where the real problem comes in. If we stubbornly hold out for the $2,400 a month, which you can do, there's a strong likelihood of having at least 1 month where the property does not rent out. And if you think about the cost of not getting a couple $1,000s, let's just divide that over 12 months. That is an extra $167 per month you didn't receive if you just average it out over the course of a year. What's more likely is you're going to not rent it for the first month. So you're going to lose $2,000 there. And then you're probably going to take a price reduction back down to $2,200 or $2,100. And it may or may not rent the second month. But by the third month, if you're back down to the $2,000, which by the way, you could have just renewed at, you're losing 2 or 3 months worth of rent. It's $6,000. The difference of the year, $400 a month, one for last year, one for this year, is $4,800. So in a month or two, if you don't rent out at the higher price point, you're losing money. I'd argue if you lose 1 month of rent, you're going to lose money, because it's going to take at least another month to get somebody in there. At best, you break even stubbornly holding out for the higher price, which, if you think about it, is just not possible. And when you look at the rental comps that are available right now, it's super easy to see what your competition is going for. And if you don't believe me, drive around the neighborhood where your rental property is, call the sign, or just Google it and find out what's the rent. And if it's the same or similar to your home and you're out by hundreds of dollars, you see, you already know what's going to happen. Now, what I can tell you is this. Let's suppose that the difference is about $200 a month. This is pretty common. You have to ask yourself, do I want to risk getting $200 extra per month? That's $2,400 per month extra, for the whole year. $200 a month, 12 months, $2,400. But if I lose $2,000 because I didn't rent it for 1 month, you're within a $400 range, and the subsequent month means you lose $4,000. You're losing money to get the higher rent price, if that makes sense, if you get it. What I would say is treat it like a lot of people treat a 401k. If you can control a property that's worth $250,000, $300,000, $350,000, and you have to write a check every month for a couple $100, it's a pretty good deal. Because what happens? Every month, the mortgage balance comes down. I'm going to take a wild guess that if you put $200 in, I bet the mortgage balance is coming down more than $200 a month. So you're net positive when you think of that. You're going to be able to pay that mortgage down more than you're putting in. That's a profit. It's on paper, but by the way, so is your 401k. And when it comes to tax time, you're likely to be able to take a write-off because you're going to depreciate it. It's a rental property. There's probably some tax advantages, which would also add to the gain. And by the way, if property values go up 3-4% in the next year at $300,000, that could be $9,000 or $10,000 worth of equity that's increased in the house. So let's walk it back. Let's call it $10,000 increase in equity. And let's say that you paid down $300 a month in principal. That's another $4,000. You're up to $14,000. And with a write-off, it could be $15,000, $20,000 of cash benefit on paper, but it's your wealth building strategy that's allowing this to happen. I'd argue forking over a couple $100 a month, $2,400, might get you back 5 to 10 times that back in actual appreciation, depreciation, and also principal reduction. So for a lot of people, it makes sense to continue to be an accidental landlord and bite down hard and take the paper loss of having to contribute a couple $100 a month, because in the end, you're winning. And I know that most people don't see it that way, but if you follow the logic and follow the money, it's actually a great strategy to kick in a couple $100 a month to control a property worth upwards of $300,000. If you got questions about the math, or now you're ready to get that property rented out, give us a buzz, definitely subscribe, and give us a call. We're here to help. This is Ron Wojciechowski at Blue Palm Property Management.